Hello, my name is Graeme Lamb. I'm the director of Quo Vadimus Media Ltd and a writer of a number of books on accountancy and bookkeeping for AAT and others. And this is another episode in our series on AAT Level 2, Introduction to Bookkeeping. And this is episode 3, Liabilities. This is for any current students or prospective students who are looking at the AAT Level 2 certificate in bookkeeping or the AAT Level 2 certificate in accounting, which covers the units Introduction to Bookkeeping, which is what this range of lessons is about, and also Principles of Bookkeeping Controls, which is going to be followed up in a later video course. In this episode, we're going to look at liabilities. Having looked at assets in the previous episode, we're going to look at their counterpart, their opposite almost in a way, in double entry bookkeeping, liabilities. And we are going to look at what are liabilities, what do they mean to a business, and how are they recorded. And by the end of this little episode, you'll have some idea of what liabilities are. You'll be able to identify some of them, and you'll be able to see how they begin to be recorded within the double entry bookkeeping. So in terms of what are liabilities, well, a little bit like assets, which I mentioned in the previous episode, there is an official definition of them within the International Accounting Standards, which we're not going to go into here just because it's a little bit more complicated than we need at this stage. But you will come across that definition as you will for assets when you get to level 4. But basically, the easiest way of understanding liabilities at the beginning is basically money owed. So it's money owed to credit suppliers by the business. So perhaps as a business, you have bought some goods or services or some raw materials, for example, on credit, and you haven't paid for those yet. So you still owe those. So you owe money to those credit suppliers. And it's also money owed by the business to any other parties as well. So really, it's any money that is owed to any other parties. Definition of liabilities can get a little bit more complicated than that, but as much as we need to understand it at the moment, just understand it as money that is owed to someone. So we can categorize them as we did with assets as either being current liabilities or non-current liabilities. Looking first at current liabilities, generally with current, by the way, we would generally define current as money which is owing and expected to be repaid within 12 months. I suppose the one complexity here is the bank balance if overdrawn, because a business may technically have a bank balance which is overdrawn for more than a year, but we would still consider it as a current liability in this particular case. Any short-term loans as well. So short-term loans here basically means loans that we are expecting to finish paying off within the next 12 months. Any sums owed to credit suppliers, because they're typically 30 or 60 days. Any money that's owed to HMRC in terms of income tax, in terms of contributions or VAT, they are normally relatively short-term liabilities. Any money that's owed to pension funds, for example, because of money that's been earned by employees, which is now owed to a pension fund. Any money owed in terms of credit card payments. Accrued expenses. Now, accrued expenses, we look into detail at level 3. But all I'll say about accrued expenses at this point is basically expenses that you've accrued, really. So you've incurred the expense, but you've not yet paid it. So that's what we mean by an accrued expense. Or dividends, for example, which are owed to owners and shareholders, etc. They count as liabilities. Just a couple of real life examples. Literally at the point of which I'm recording this episode for Quo Vadimus Media, within the next few days, I'm actually going to be making payments for corporation tax, which is owed on the profits of the business last year, and also payment of dividends to myself. as the main shareholder. They are therefore currently sitting in my balance sheet as liabilities. They are money that is owed. In terms of non-current liabilities, the most likely ones, there's 4 here, but really 2 that you are likely to come across at level 2. Mortgages, long-term loans, long-term leases potentially, and pension benefits as well. But I'm only going to really talk here about mortgages and long-term loans because they are the only ones that you are likely to come across at AA level 2. Mortgage, of course, is basically a loan on a property, whereas a long-term loan could be a loan to buy capital, machinery, equipment, etc. Just to be aware of, for both mortgages and loans, they would be considered to be non-current liabilities as long as there is a year or more of payments left to be made on them. But once there is less than a year of payments, they will become current liabilities. So for example, if I as a business took out a 5-year loan, for the first 4 years of the loan, then it will be considered as a non-current liability, and then in the final year of the loan it would be considered as a current liability. But generally within your studies, if you are coming across a loan or a mortgage at level 2, you should consider it to be a non-current liability. As we looked at with assets, there is bookkeeping for liabilities as well. We saw with assets a purchase of machinery, and there was a debit entry in the asset account. That's because according to the rules of double entry bookkeeping, asset accounts have debit balances. Liability accounts, being their opposite, have credit balances. So we have an example here of where a business has taken out a loan of £25,000, which means they're creating a liability of £25,000, which is the bank loan. But the business has also increased its assets by £25,000 because they've got money in the bank. So we've got at the top there in the bank loan account 2,500. Remember we talked about sort of 4-digit coding in a previous episode. In the 2,000 range tends to be liabilities. So that's what we have there. There is a credit entry. So now the bank loan account, which is a liability account, is showing £25,000, which is the amount to be repaid on the loan. Whereas in the bank account, there is a debit entry because the bank has received £25,000. And we're going to look more at those debit and credit entries in a few episodes' time when we start to look at the double entry bookkeeping system in a little bit more detail. But just the main thing you need to understand at the moment is that liability accounts will have a credit balance. They may well have debit entries. So that bank loan account will have debit entries as the bank loan payments are made, but it has a credit balance to start with from that point of view. And this one is also an example of something which is called the dual effect, which we'll look at in later stages as well, which is that every transaction has 2 effects. So this particular transaction increases the liabilities of the business up by £25,000, but also increases the assets of the business by £25,000 at the same time. That links to something that's called the accounting equation, which we're going to look at in 2 episodes' time. But always watch out for that in your double entry bookkeeping when you're looking at transactions. Every single transaction has 2 effects. So it's not just identifying the effect that's in one account. It's about identifying the effect that's taking place in 2 accounts and understanding which effect is taking place in which account. And that's a huge part of understanding how double entry bookkeeping works. So that's enough for liabilities for now, but we will, as with assets and with other things, we're going to keep coming back to them in more and more detail in other episodes. But this is basically the end of episode 3. So our next episode is going to be on the theme of capital and drawings. So we've looked at assets in episode 2. We looked at liabilities in this episode. We are going to look at capital and drawings in episode 4. And in particular, because we're looking looking at capital and drawings, we're mostly going to be thinking about sole traders. So we're going to be looking at what are capital and drawings? What do those words mean? How do they apply? What do they mean to a business? And again, how are they recorded? And we'll see a little bit of how they look within the double entry accounts, and we're starting to build up that knowledge of what those things mean. So by the time we get to episode 4, we'll have looked at assets, liabilities and capital, which preps us for episode 5, the accounting equation, and also we'll have looked at drawings. So we'll be starting to build a little bit of a knowledge base on which we can add some more things later on. If you have enjoyed this video, please do subscribe and like our videos. That helps us to get videos and to get this AAT knowledge in front of as many as people possible, to help as many people as possible to help get through their AAT Level 2 studies. There's also information over on our website, quovadimusmedia.co.uk. We do have an online shop, but it's not currently selling anything AAT related. However, over on our website, there are publication pages for each of our major publications, including all of our AAT Level 2 study guides and links to where you can purchase them in print, but also from Kindle as well. And obviously those study guides build a lot more on the material that you've got here, with a lot more examples, practice questions, etc. Do please follow us on the various social platforms as well. We are on X, we are on Facebook, we are on Instagram, Blue Sky and LinkedIn. And I'm personally on quite a few of those platforms as well, if you want to come looking for me, Graeme Lamb. You can search for Quo Vadimus Media Ltd and you can find us on the social platforms there. Other than that, goodbye for now, and we look forward to seeing you in our next episode, episode 4, where we'll look at capital and drawings.